Good morning, friends. We will take up on to question number 3, page number 448. Problem number 1 and 2, I think we have just finished. We will take up on to problem number 3, page number 448. Holding additionally in preference share capital and debentures is the title. H Limited acquired control in S Limited a few years back when S Limited had 25,000 in reserves, 14,000 in profit and loss account. Plant account book value 66,000 of S Limited was revalued at 62,000 on the date of purchase. Equity dividend of Rs 7,500 was received by H Limited out of the pre-acquisition profit, and the amount was correctly treated by H Limited. Debenture interest has been paid up to date. Following are the balance sheets of H Limited and S Limited. Balance sheet on 30th of September 2011. Equity share capital 6%, preference share capital, general reserve P&L account 6%, debenture, sundry creditors due to S Limited, bills payable, goodwill, building, plant and machinery, stock in trade, sundry debtors, bills receivable due from H Limited, bank, investments in preference share capital and in equity shares, debenture of a face value of Rs 50,000 at 43,000 given. Check of Rs 2,000 sent by H Limited to S Limited was in transit. Balance sheet was prepared before providing for 6 months dividend on preference shares. Dividend for the first half being already paid. Both the companies have proposed preference dividend only, but no effect has been given in accounts. Stock of H Limited includes Rs 6,000 stock purchased from S Limited on which S Limited made 20% profit on cost. Stock of S Limited includes Rs 10,000 purchased from H Limited on which H Limited made 10% profit on selling price. Since acquisition, S Limited had written off 30% of the book value of the plant as on the date of acquisition by way of depreciation. Bills receivable of S Limited is due from H Limited. Prepare consolidated balance sheet. As I told you that first one cut off. So fast you can update. Date of acquisition not given. Date of consolidation 30th of September 2011. Number of months fallen prior to and after is not an important information, not required at all. Percentage of holding in equity, they are holding even in preference. Percentage of holding in equity is 7,500 shares, they have mentioned on the asset side. That should be divided by 10,000 shares that they have issued. So it is 75%. So minority interest 25%. In the case of preference share capital, 300 preference shares against 500, that comes to 60%, then 40% for minority interest. Remember on the other day when we were closing the consolidation, we have not considered preliminary expenditure. Remember, as we were inducting, our friend was asking this question, why preliminary expenditure should be inducted? Preliminary expenditure, what you find today is the formation expenditure of the company. So quite naturally, it should be very much there at the time of acquisition, part and parcel of your capital profit. Therefore, what we have missed out, we have inducted later. So therefore, preliminary expenses on which there cannot be any increase, just like what you find in the case of general reserve and profit and loss account. It is an old item existing. So part of the capital profit we should consider. We forgotten, later on we have inducted. So minority interest we have just worked out. Then they also have some debentures. What is the debenture face value? 50k out of 100k. So 50%, there is no question of minority interest there. The cost of investment is how much? 45k. Face value 50, bought at 45, definitely there is profit on cancellation. Then we require classification to be taken up. What is this classification? We take up the general reserve of subsidiary company. How much is the figure you have against general reserve? 30,000. Date of acquisition and after acquisition. How much is that they mentioned that they had in general reserve? So in the previous page they have just mentioned. They had rupees 25,000 there and 5,000 after acquisition. So this being capital and this being revenue. So 25,000 has capital profit and 5,000 as revenue profit. Profit and loss account. How much is the figure for profit and loss account that you find there? 12,000. All of you please remember, the figure that you take up for classification should be the figure that is attributable to equity shareholders. In case you find the company failed to pay or not provided for in the books for preference dividend or for debenture interest, we should deduct them, and only the sum that is to be taken against equity shareholders alone you should take up for classification. Ultimately, the classified profit will be distributed to parent and minority interest in the ratio of 75-25. When the figure for profit what they have reported is before deducting towards preference dividend, how is that we can distribute without providing for preference shareholders the preference dividend? So naturally we have got to deduct in case they have failed to do so, and let us just take up preference dividend. Preference dividend is not for the full year. Preference dividend they have got to pay only for the second half. Where is that they mentioned that they have not paid for the full year? So look into adjustment number 3, they have mentioned both the companies have proposed preference dividend but no effect has been given. In adjustment number 2 they have mentioned balance sheet of S Limited was prepared before providing for 6 months dividend on preference shares. First half already paid. So 6% on how much? 50,000 for 6 months period. How much it comes to? 1,500. So the profit attributable to equity shareholder is 10,500. Correct? This we have to identify as date of acquisition, after acquisition. This is to be distributed as date of acquisition and after acquisition. How much they had at the time of controlling acquisition? Go to the previous page and check up. They have mentioned they were having 14,000 rupees. Now 14,000 rupees cannot be continuing even today, because today we have only 10,500. That means this 14,000 rupees on which they would have declared dividend or they would have caused some disturbance or they would have distributed. They have mentioned in the same paragraph that equity dividend of 7,500 was received by H Limited out of pre-acquisition profit. They themselves had provided the link. So how much we should deduct? Not 7,500 alone. If 7,500 the parent company had received for their 75% share, how much the subsidiary company would have declared as dividend? 10,000 rupees. So of the oldest balance continuing today is only that 4,000, and this should be taken up as capital profit. The remaining 6,500 should be taken up as revenue. Are you understanding, all of you? So today what you have as 12,000 is before deducting towards second half preference dividend, deduct that and distribute that between the date of acquisition and after acquisition. What you had at the time of acquisition was 14,000. From there, subsidiary company had declared 10,000 rupees as dividend. How is that we have got this figure of 10,000? From what they given as 7,500, the parent company received for 75% of their capital. Naturally, the subsidiary company would have declared 10,000 rupees as dividend. And that is the way we have just got this figure. Are you clear? And apart from that, we do have some revaluation adjustment. Where is that they have mentioned regarding this revaluation adjustment? They are given in the same paragraph. In the previous page, 448, they mentioned that the planned book value of rupees 66,000 was revalued at 62,000 rupees. So that is an indication that we have to go for revaluation adjustment. So plant appeared at 66,000 should be valued at 62,000, which would cause revaluation how much? Loss. How much? 4,000. Revaluation loss there to the extent of 4,000, which is to be considered as part of capital profit. Excess depreciation at the rate of 30% on 4,000. How much it works out to? 1,200. This is to be considered as part of revenue profit because it is a matter related to post-acquisition. Are you understanding? Then apart from that, you have stock reserve. Where is that they are given the stock reserve adjustment? Take up question number, that is adjustment number 4. What is that they mentioned in adjustment number 4? Stock of H Limited includes 6,000. So stock reserve number 1. So H Limited stock, how much? 6,000. Markup ratio, how much is markup ratio? 1/6. 1/5 on cost is equal to 1/6 on selling price. So stock reserve 1,000. Type what? Down, upstream. Upstream stock reserve, S Limited stock, how much? Markup ratio 1/10 on selling price. Stock reserve 1,000. Type what? Downstream. Okay, all of you, come on, kindly just make note. Those who joined late, please just make note from here. Shall I proceed? Now, how we make a presentation, that will tell upon how fast we get our answer. Single sheet, we require only 3 items. The first column will help us to find out goodwill capital reserve. Second column will help us to find out minority interest. Third one, consolidated profit and loss account. Only these 3 items for which we are doing all this exercise. So therefore, we will bring all our understanding to this particular stage and let us just get the answer right. Date of acquisition, date of consolidation, difference. See, normally the difference will be only for consolidated profit and loss account. But in this case, you have there is revenue, reserve, the other one revenue profit. That is what is considered to be as general reserve. The other one, it could be profit and loss account. That's it. So therefore, this difference is nothing but a total. The breakup of which you are providing like that. Are you understanding? Now, what are the items that we will take up? So whatever, see, patiently you got to approach. You got to be quick. Quick should not be understood as slow. Fast. Quick in the sense without hasty thing, with a good amount of understanding we need to apply, that is quick. So I will not say it's fast. It's quick in the sense you think and then do it. Okay. First one, equity share capital. Then what are the items that you have? You make note. General reserve. What is the next item? After general reserve, what is the next thing that you have taken up? Profit and loss account. Then after profit and loss account, what is that you have taken up? Revaluation. Profit or loss, don't worry. You will accordingly just put within brackets or without brackets. Then correspondingly, excess depreciation. Stock reserve. In which stock reserve you have to take up? Upstream. Downstream, only at the down. Keep that in your memory. Nothing else we will take up. Preference share capital we do have, we will take it up later because the percentage of holding is 50-50. Correct? And not 75-25. Now, okay, not 75-25. Huh? You will do all sorts of audits in wrong places. 1 lakh, 1 lakh. Difference nil. Next, general reserve 30,000. Say how I am updating, just watch out. Date of acquisition, in one stroke you finish it up. Whatever you just take it up from 10,500 only. So it appeared 12,000. From there, 1,500 I have deducted for proposed preference dividend for the second half. Remember that revaluation. This is not, okay, this was not there, we will update that. Now, these are the 3 matters we have taken up. Now we will update date of acquisition. What is the date of acquisition figure for general reserve? 25,000. Profit and loss account? 4,000. Now we will update each one. 5,000. 5,000 dash here 6,500 dash 6,500. Now we will concentrate on the last 3. Revaluation adjustment. How much is the revaluation adjustment? 4,000. 4,000 within brackets. Loss. 4,000 within brackets. Dash, dash, dash. Excess depreciation 1,200. It is purely post acquisition. It should be adjusted only in revenue profit. Are you understanding? Next, upstream stock reserve, which is a matter to be deducted. profit made by subsidiary company. So therefore in subsidiary's profit we are adjusting. It should be adjusted in revenue profit because that company made profit, which is not a profit at all. Now we will take the calculator, we will total up. 1,25,000. 1,36,700. 7,000. 11,700. 5,000 and 6,700. Correct? All of you? Percentage of holding. First one for parent only. How much? 75, 25. This is 75. But instead of writing against total column 75, we will note down 75 against this. Correct? How much is that? Share of net asset. 75% of 1,25,000. 93,750. 136,700 into 0.25. 34,175. Here I am not updating. 3,750